Welcome to the exciting world of options trading. This video is your guide to the myriad strategies and techniques that make this form of trading so intriguing. Remember, this is purely educational. We're here to provide you with a solid understanding, not to give you financial advice. The goal is to empower you with knowledge so you can make your own informed decisions. It's a wild ride, but you're in for an enlightening experience. Now let's journey into the fascinating world of options trading. Scene script. Options trading, a mysterious term for many, but not for long. Let's dive into the world of options trading. Imagine options as a type of insurance policy. They give you the right, but not the obligation, to buy or sell an asset at a specified price on or before a certain date. In the options trading universe, there are two main types of options you need to know about: call options and put options. A call option gives you the right to buy an asset, while a put option gives you the right to sell an asset. The price at which you can buy or sell the asset is known as the strike price. This is the agreed-upon price between the buyer and seller of the option. Remember, with options, you're not obligated to buy or sell. You merely have the right to do so. The expiry date is the last date on which the option can be exercised. If the option is not exercised by the expiry date, it becomes worthless and the buyer loses the premium paid for the option. So, in essence, options trading is a way for investors to speculate on the direction of a security's price, hedge against potential price changes, or generate income from their investments. Now that we have a basic understanding of options trading, let's examine the different strategies involved. The first strategy we'll explore is the long call strategy. Picture this: you're at an auction. There's a painting you fancy, but the price is too high right now. You expect the price to rise in the future, so you buy an option to purchase the painting at a certain price, let's say $100, within a specific time frame. That's a long call in a nutshell. It gives you the right to buy an asset at a predetermined price within a set time. Now, translate this to the stock market. You're betting on a stock's price to increase. You purchase a call option, locking in a buy price. If the stock price soars as you predicted, you can buy at your locked-in price, then sell at the higher market price, reaping the profits. Conversely, if the stock price falls, your loss is limited to the price you paid for the option. That's the long call strategy for you, simple yet powerful. Next up is the long put strategy. You see, this strategy is all about potential. It's used when you expect a decrease in the price of the underlying asset. In layman's terms, you're betting that the price is going to fall. So how does it work? Well, you buy a put option, which gives you the right but not the obligation to sell a specific amount of an underlying asset at a set price within a specific time period. Let's say, for example, you buy a put option for 100 shares of company XYZ at $50 per share, valid for 1 month. If the shares drop to $40, you can sell them at the higher contracted price of $50, making a tidy profit. Of course, it's not all sunshine and rainbows. If the price doesn't drop, you lose the premium paid for the option. But that's the nature of the game. And that's how the long put strategy works. Isn't it interesting? Now, let's delve into the covered call strategy. This strategy is commonly employed when an investor owns a stock or other type of asset and sells call options on that same asset. The idea is to generate income through the premiums received from selling the calls. Imagine you own 100 shares of a company. Let's call it Tech Titan. You believe that Tech Titan's stock price will remain stagnant over the next 2 months. To generate a little extra income, you sell a call option on your Tech Titan shares. This call option gives someone else the right to buy your shares at a predetermined price within a specified time frame. If Tech Titan's stock price remains stagnant as you predicted, the call options will expire worthless, and you keep the premium. But remember, if Tech Titan's stock price skyrockets, you're obligated to sell your shares at the predetermined price, potentially missing out on some gains. And that, my friends, is the covered call strategy. Let's now explore the protective put strategy. This strategy is like an insurance policy for your stock portfolio. It's used when an investor wants to limit potential losses on a stock they own and are bullish on in the long term, but are concerned about short-term uncertainties. Here's a simple example. Imagine you own 100 shares of a company, but you're worried the price might drop in the next few months. To protect your investment, you could buy a put option, giving you the right to sell your shares at a set price, the strike price, within a certain time frame. If the stock price falls below the strike price, you can exercise your option and sell your shares at the higher strike price. But if the stock price rises, you only lose the premium paid for the put option, and you still benefit from the increased value of your shares. That is the protective put strategy in a nutshell. Last but not least, the straddle strategy. This is an options trading strategy that investors use when they expect a significant price movement but are unsure of the direction. It involves buying a call and a put option with the same strike price and expiration date. Let's imagine you're an investor who believes that a company's stock price is going to make a big move following its upcoming earnings report, but you're not certain if the stock price will rise or fall. To capitalize on this uncertainty, you purchase a call option and a put option at the same strike price. If the stock price drastically rises or falls, one of your options will become profitable, potentially offsetting the loss on the other option and even leading to a net gain. It's a bit like placing two bets in opposite directions. One of them is bound to win. And that's the straddle strategy for you. It's quite an intriguing one, isn't it? We've covered quite a bit today, haven't we? We embarked on a journey to understand options trading, a financial instrument used to hedge risk or speculate on the price of an asset. We learned that options give the buyer the right, but not the obligation, to buy or sell an asset at a predetermined price within a specific period. We looked at the long call strategy, a bullish approach where you buy a call option with the expectation that the price of the underlying asset will rise. It's a strategy that limits your losses to the premium paid, while your profits can be unlimited if the market moves in your favor. Then we moved on to the long put strategy. This strategy is used when you expect the price of the underlying asset to fall. It's like having an insurance policy on your stocks, capping your losses while offering the potential for significant profits if the market takes a downturn. The covered call strategy was next on our list. Here, you own the underlying asset and sell call options on it. It's a way to generate additional income from the asset during periods of minor price fluctuations. Next, we delved into the protective put strategy, another insurance-like approach. You own the asset and buy a put option to protect against a significant drop in the asset's price. Lastly, we explored the straddle strategy, a strategy employed when you're unsure of the market direction but expect significant price movement. You buy both a call and a put option on the same asset with the same strike price and expiration date. These strategies, when understood and applied correctly, can help you navigate the fascinating world of options trading. They provide a range of possibilities, allowing you to tailor your trading to match your market expectations and risk tolerance. And that's a wrap on our journey into options trading. Remember, knowledge is power in the world of trading. Until next time, happy learning.